Thanks for tuning into the Portfolio Manager. It's been a while that we've done the show, but it's a special guest, a high-performance fund manager in his earlier avatar, now the founder and CIO of IKIGAI Asset Manager. Pankaj Tibrewal joins in right now with his thoughts on how should an ideal portfolio construct be in a scenario like this. Pankaj, great having you. It's been a while. Thanks for taking the time out and speaking to us.
It's always a pleasure to be with you, Neeraj, and I think you're one of the best in the industry.
Thank you so much. I can very easily say that the same for you, Pankaj, to be very honest, and which is why just great doing this show with you. Before I get to what Ikigai's philosophies would be and how would you do a portfolio construct currently, Pankaj, tell us, do you sense a change in the investment landscape in the current period, looking at the risks, rewards and the valuations and India's place within the world versus what could have been pre-COVID or maybe even the post-COVID era?
Absolutely, Neeraj. I think post-COVID, I think a lot of things have changed and the landscape geopolitically is not very conducive. And India has found its own place in the overall global landscape today. However, one thing which is very important to note that last couple of years have been very, very charitable for all the market participants. I think the broad market has really made money for everybody. But incrementally, when I look around, I think risk is underappreciated. And over a period of last couple of years, money making has become too easy. And I think people are extrapolating the last couple of years into the future as well, which may not be the right thing to do. And when I look at across different parameters, I get a little worried about the way liquidity is only driving the overall valuations in the market today. Let's look at a few of the data points. The first data point is the distribution of market cap and profit. So if you look at now mid and small caps today is about 36% of overall market cap, whereas their profit contribution is about 25%. And large caps have come down to about 65% of overall market cap. The second data point to note is that the bond yield minus the earnings yield in mid and small caps is at its worst levels you have seen in the last 15 years. So I think that also point out that the risk reward over a period of time may not be favorable. The third point, which I think is a most important point, is that over the last couple of years, the earnings growth has been quite strong for the broader market as a whole. But when I look at the fourth quarter numbers and I dissect it into two parts, one is the BFSI space, and the next is the non-BFSI space. And every quarter I look at the top 500 companies of India, and 87 companies are banking and financial companies, and 413 companies are non-banking and financial companies. The headline earnings growth for NSE 500 companies was about 14%. But when you dissect into these two parts, the banking and financial companies grew their profits by 24-25%. But the non-banking and financial companies, where the bulk of India lies, grew their profits by only 7.5-8%. And top line was also weak. So I believe that over a period of time, if earnings growth starts to slow down, probably the valuation may not sustain, which in many pockets are looking very frothy. So I think in the next 12 months, we need to tread a lot with caution, making sure that we don't compromise on the basics of investing. Look at the cash flows. In many pockets, I am seeing today that the market caps are between 20 to 30,000 crores, but the operating cash flow over the last 5 years is not even adding to 100 crores. So these are pockets where you will make mistakes, and probably over the next 3-5 years, when we reflect back, you probably will repent. So I think basics of investing should not be compromised in this landscape as well.
So market-wide, do you sense an earnings issue, Pankaj, or do you reckon that this will be theme-specific? There could be pockets which could get hit badly because of earnings drifting lower over a period of the next 12 months.
So look at the last year. Last year was 30% earnings growth for BSE 500 companies. Our sense is this year it will come down to 13 to 15%. So when earnings is de-accelerating from 30% to 13, 15%, obviously there will be certain pockets in the market which may disappoint you on the earnings growth side. And don't forget, Neeraj, that last year you saw the tailwind on margins because of commodity prices coming down. I think that's in the base now. And from here on in the next 12 months, the margin tailwind may not be there. And top line, any which ways, is being sluggish between 4 to 6%, tracking the WPI. I think in that environment, volume growth will be the only driver for most of the companies across the board. And I think that could be a little challenging looking at the landscape at the ground level today. And also one interesting thing which may happen is the redistribution of your budget expenditure. And last 4 5 years, if you look at the rural expenditure has been flat at about 5 lakh crores, 4 lakh crores. And capex has gone up from 3.5 lakh crores to 11.5 lakh crores. So you saw significant re-rating in capital goods, infrastructure needs, and so on and so forth. Our sense is that a part of that capex increment, which happened over the last 5 6 years, will see move to consumption or rural expenditure. So I think there could be certain pockets which one may avoid because of frothy valuation, and a redistribution of the government budget expenditure could also drive certain earnings upgrade in certain cycles and downgrade in certain. So it will be a stock picker's market in our view. The broad base of rally which we saw for the last couple of years, I think it's behind us. From here for the next 12 to 18 months, one needs to be very stock specific, and bottom-up stock selection will be rewarded.
You reckon they could move the numbers a bit from what was mentioned in the budget as well for capex, Pankaj?
See, we saw about 25 to 26% CAGR in the capital.
Yeah, but it was sorry, but it was 18 odd percent, right? In the Feb budget. You reckon that could get lowered?
Maybe 17-18% for this year, but incrementally,
got it.
Incrementally, my sense is a part of that could move to the rural expenditure, which has been flattish for almost 4 5 years at 4 lakh crores.
Got it. Okay. So Pankaj, what's the ideal portfolio construct? What we'll do is we'll try and, since we are in that topic, let's figure out the current times. Then I would love to, in the second segment, talk about the basic investment philosophy as well, which might be time tested and stand the test of time. But since you're on the current topics right now, let's talk about that. How would you therefore build out a portfolio in the current times? Is there cash that you would sit on? If not, where is it that would it have a more defensive bent? What are the themes that you would largely focus on?
So I think 3-4 themes, Neeraj, which probably are looking okay. One, I think, is the entire private sector financials, which I've been talking about. I think for the last couple of years, you saw a very sharp disconnect between PSUs versus private. I think that big rally in PSUs is behind us, and incremental earnings growth should not be too different for a PSU versus private sector bank. And I think last couple of months, you have started to see that shift happening of capital happening from PSU to private sector. So I think that's one area where one should keep focus on. The second is, I think, the entire consumption basket. And incremental R channel checks suggest that things have started to improve on the consumption side. But it's a very, a different topic, because the consumption basket over the last decade has gone through a massive change. About 6.5 to 7 lakh crores now is getting spent on things which were not existing a decade back. For example, smartphones, hearables, wearables, OTT, mobile data. All these things which were never a part of your consumption basket has now become almost $80-90 billion. And I think we need to be very careful on the names we kind of move on to the consumption. But initial signs, consumption is picking up, and a close eye on monsoon. I think that should be a space where volume growth has been absent. Last 4 years, people have seen time correction in the stock. And probably if earnings growth starts to pick up, I think that segment could be quite okay. And it has to be a mix of both rural and urban discretionary. The third is the auto ancillary. And I think the play there is both the underlying domestic auto industry picking up, plus the export opportunity which is getting created. And many companies in this space, when we are speaking, there are two big changes happening in this space. One, India is becoming a domestic hub for their other factories across the globe. And many companies which are part of that are seeing that benefit coming from an export opportunity perspective. And the second big change which we are seeing in some of the auto and industry companies are that they are also moving towards industrials. So today, for example, an auto ancillary company, almost 80-90% was autos, 10-15% was non-autos. That 10-15% is becoming 40 to 45% over the next couple of years. And hence you can see a significant multiple relating because you will de-link yourself from the auto sector. So that's another space which is looking good. Pharma is again looking very decent in terms of both valuation as well as the earnings growth story. And we believe that the US generic cycle, the 10-11% price erosion which you were seeing, probably is now come down to 3 to 5%. And you could see earnings upgrade happening on the pharma sector as well. So these are some of the areas and pockets which are looking okay. We are keeping a very close eye on specialty chemicals also. I think we have seen a very sharp price erosion as well as time correction in many of them. We believe that the agri cycle is bottoming out. And from there, if global agri restocking starts to happen, many of these specialty chemical companies could probably benefit as you go back. So portfolio has to be today diversified. You can't take very significant bets on a concentrated right now because a couple of bets going wrong can see whatever returns you have made over the last couple of years getting diluted. So it's time to be a risk manager more rather than a fund manager and make sure that you are in those stocks, which if it corrects by 20 to 25, 30% in any given day, you are able to average it out. Many a times we see that, Bhav Bhagwan, people, the company becomes good when the price is very, company becomes bad if the price starts, correct? And you don't have that confidence to buy at a lower price. I think this is a time to be fully convinced that if you're buying any stock, be mentally prepared that it can see a price corrections over and at a lower price, can you be able to average it out? I think these are some things which you need to keep in mind when you navigate the market over the next 12 to 18 months.
I love the saying that time to be a risk manager more than a fund manager. But Pankaj, just before we take that break, just getting that clarification. For the longest time, concentration, having a few stocks and having very large positions in them was the holy grail of sorts. Is your answer suggesting that currently it might actually be better for a fund manager to not have a too concentrated a portfolio, have it slightly wider to account for possible accidents if they were to come about?
Absolutely, Neeraj. I think this is a constant debate globally for many, many decades going on.
Yeah.
Concentration versus diversification. And I think most of us get it wrong that a 15 stock portfolio is better than a 40 stock portfolio. I think the right way to look at is what is your active share in the portfolio. And by active share, I mean the percentage of portfolio which is not replicated as a part of benchmark, which you are tracking. And if you have a 15 stock portfolio, but your active share is only 15%, it doesn't make sense because your alpha creation will be very limited. But if you have a 15 stock portfolio, but an 80 to 90% active share, you will have a lumpy performance over a period of time. That means 2 years you will be a hero, and next 2 years, if a couple of your calls don't go right, you probably will come down to the fourth quartile in terms of performance. What my style and my philosophy and at Kotak and now at IKIGAI is that have 50-55% active share in the portfolio, have about 40 to 50 stock portfolio, be a little diversified, and make sure that that becomes more consistent in nature. I think markets and our interaction with most investors is they don't want the number one fund. If it happens, it's good. But sustaining number one for a long period of time it's impossible in my view. And that can only happen because of portfolio construction. I think industry has spent a lot of time in talking about stock selection. But I think if you ask a real fund manager, if you ask me for last 2 decades, what has given me the consistency in my portfolio, stock picking is just one part. It's the portfolio construction, which is the most important part. And if you design your portfolio in a right way, which can survive cycles, which can survive bull and bear market, I think over a period of time, you will see consistency coming in that returns. So I think portfolio construction is very, very key.
Okay. Let me first, before I continue a conversation with Pankaj Tibrewal, let me get in my colleague Puneet for a quick roundup of what's happening currently, because Pankaj made a very interesting point in the first segment about how select auto anchors, which are diversified away from autos, are actually showing strength. But autos itself, what's in store? Puneet, actually, can you give us a quick roundup of what's happened in the monthly sales numbers first?
Well, very few of those companies have reported the sales till now, but let's start with Mahindra & Mahindra, which has been a beat in this particular month as well. The PV segment growing by roughly 23%. On an overall basis, while the growth has come in at 11%, just shy of analyst expectation of 14%, we have seen good growth across his passenger vehicle as well as his commercial vehicle portfolio. For domestic sales, the tractor sales have been good, coming in at roughly 6% growth compared to the same time last year. Now, this is higher, much higher than what Escorts has reported, which is a 2% fall, and we'll deep dive into that as well. When you look at the three-wheeler sales, also they have been around the flattish range, but the PV sales have been good, coming in at 23%. The 3X, so we've spoken about that in the morning show as well. The top variant has roughly 10 to 12 weeks of waiting period, while the entry-level segment has roughly 32 weeks of waiting period. So the product has been very well accepted, and we will be seeing Mahindra increasing the production per month going forward as well. When you look at the second one, which is Escorts, it did report a 2% fall in sales, while exports form a very minuscule part of the total sales. They were down 60%, so we'll be expecting more commentary from them as well. And as well as what's happening in Maharashtra, Uttar Pradesh, as well as Karnataka, which are three key states for both these tractor makers. Mahindra has a 50% market share in Maharashtra, and since this is the last month before the Q1 results, we will be seeing more commentary in the Q1 conference call as well, and what they have to say. Finally, on Bajaj Auto, it was expected to report flat numbers, but it has come out with a 5% sales growth in this particular month. This has been fueled by the commercial vehicle sales growth, which is coming at roughly 16% in the domestic CV market, while the export market has grown 14%. Motorcycles have shown decent growth of roughly 3% in the domestic market, while exports have been flat. The 400, which is one of the key products, is still yet to reach dealers so far, so we'll be waiting for more commentary on when that happens. Back to you.
Thanks for that, Puneet. Pankaj, just one quick follow-up because of these auto numbers, because I heard you made a very interesting point. You sounded cautious, or you rather sounded fairly confident on some of the auto anchors by virtue of the fact that they are kind of moving away from being pure auto ancillaries in the first place. Autos have had a splendid last 3-4 years, right? I mean, do you think the best is behind us now?
I think many of the companies, Neeraj, are pivoting from only being pure auto to now being a large component coming from non-auto also. A couple of auto anchors, which probably we used to own and currently owning in our portfolios, have seen that non-auto, which is aerospace, defense, and a couple of other sectors like wind, maybe renewables, are becoming an important portion in their portfolio. And I think this is a significant change in pivoting which is happening in many of those auto and companies. And hence, you will have both the cycles running with you. One is the industrial cycle, which is more linked to both local and global, and the auto cycle. So I think many of these names can see significant re-rating in multiples, because the auto multiples generally trade between 25 times, 1.5 year forward. And the industrial piece today is trading at a valuation. So there would be a significant uptick on those multiples if they can deliver over a period of time.
Okay. And now, Pankaj, I read your some of the investing principles, your guiding investing principles, and your approach with a lot of interest. You choose to invest in high quality businesses, probably something that you've done all your life, of 2 decades, high ROC, honest, credible promoters, thinking of it like permanent owners of the business. Are these businesses available at decent valuations for you to bet on them? or do you necessarily therefore have to go to unloved sectors right now, which may turn around in the future, the way you spoke about specialty chemicals or maybe even select pharma?
Uh, Obviously, Neeraj, these are basic holy grail principles of investing which we have followed over a period of time. And we have not diluted those principles. And I believe that if you are true to label, you can find opportunities in any market across sectors. You have to be open-minded in that sense. A lot of focus goes in selection of the promoters and management teams. Because we believe in India, especially the space I operate in, which is the broader market space, the middle and small caps, we believe that promoter integrity and getting the right promoter and the management teams are very important. Because a great promoter and a mediocre business can turn into a gold mine, and a lousy and a dishonest promoter, a good business can be a well destroyed. So if you, over a period of time, look at what we have done is, we have tried to make sure that we make less mistakes. People run after multi-baggers. We made sure that in our process, we bring in a lot of hygiene factors, that how we make less and less mistakes, so that, and what not to do. And if your list of what not to do is there, and you are very well aware as a team what not to do, I think what to do becomes very small and you can focus a lot of your energies. For example, 5,500 listed companies are there in India. We track about 320 to 350. And out of that, we make a portfolio of about 40 to 50. To come to that 300, 350 and then to 40 to 50, you need very strong filters over a period of time. Let me give you a few examples. People generally look at the traits of what have been the traits of wealth creators. We invert the situation and ask that in the last 30 years, what have been the traits of wealth destroyers in India? There are common things: cash flow balance sheet being weak, leverage being there in the company, return on capital lower than the cost of equity, and they try to grow faster. That's a recipe of disaster. They dilute equity or borrow more debt on the balance sheet. Promoter siphoning of money from in the name of capex, family feud, succession plan. But also few things which are unsaid and which we discovered over a period of time, in that many of the wealth destroyers, the lady family member was never the part of board. And the promoter, whenever they know there is a financial irregularity coming in, he keeps the lady of the house separate from the board or the company. And wherever we see the opposite, it gives us a lot of comfort that the basic hygiene probably is taken care of. So few of the things which probably are not said in any investment textbook, but comes from our experience. And we have a network of chartered accountants and from a primary research perspective. And we focus a lot on management and promoter. I think that's 70-80% of your hard work which you do before you meet the company and the team. The second is the business part. That is it a small fish in a large pond or a large fish in a small pond? We like companies where they are gaining market share over a period of time, and make sure that they keep improving their edge over a period of time. And we have to figure out what it is. Is it coming from product, technology, distribution, culture? What is it that which is separating this company from the rest of the street? And the third part, obviously, is the price which you pay. And you're absolutely right that in markets like this, it's difficult. It's difficult to find companies which
Exactly
have your checklist along with valuation. So you kind of try to figure out, and weigh the options, but never compromise on the quality is something which we, kind of understand, because other thing, paying a higher valuation for a quality company can lead to time correction. But if you pay a price but a wrong quality company, it can lead to permanent loss of capital. And I think we are very, very scared on
of
anything
that.
which is
Yeah.
loss of capital.
Makes sense. Makes sense.
Over a period of time, with the help of Ambit, what we have done is, and one of the, Warren Buffett's letter had a great impact on us of 2007, where he classified businesses into good, great, and gruesome. And similarly, what we have done based on the 11 forensic ratios, which we run across all companies, we have divided into zone of safety, zone of pain, and zone of darkness. And we run that every 6 to 12 months and try to see that we are not any of our companies investing is not in zone of darkness, because that over a period of time can lead to permanent loss of capital. So a lot of our process is through elimination rather than selection. And we believe that if you keep eliminating, you will be left with a decent, a bunch. And if you can focus all your energies towards that, multi-baggers automatically come in the portfolio.
We have a segment called investing lessons, and I think there will be a lot that we'll borrow from this conversation, Pankaj. Time to be a risk manager, more elimination than selection. Lots of nuggets here. Thanks so much for that, and thanks so much for joining us on the Portfolio Manager today.
Thank you, Neeraj. It's been always a pleasure being part of your show.
Thank you so much. The pleasure was ours, and viewers, that's all time that we have on the show. Thanks so much for tuning in.